This is the second video covering swaps. We will look at basis swaps, which are really swapping two floating rates. Normally what we're used to is plain vanilla interest rate swaps where we've swapped fixed for floating or vice versa. In this case, with a basis swap, we're swapping two floating rates, and so you're really looking at the spread between these two floating rates as determining your payoffs. We will look at commodity swaps, which means you swap a commodity price for a fixed price. And then equity swaps, which means you're swapping an equity return for LIBOR, an interest rate. And then at the end, we'll cover credit default swaps and the issues there. In this video, we are not really interested in going into detail, in depth in pricing. That's not our concern. Our concern is, what are these swaps and how do you map the cash flows? So at least you get an understanding of how mechanically they work without having to get into the heavy mathematics determining various prices. As always, we'll skip currency swaps. A basis swap is a play between two interest rates, two variable interest rates. And you can think of a basis swap as being the sum of two plain vanilla interest rate swaps. Yes, that's right, the sum of two plain vanilla interest rate swaps. So if we have a swap, and I'll just look at one particular cash flow. So pretend we're on a line here, and this is where cash flows, right? We could have a swap where we receive a fixed rate, okay, and then that we pay the risk-free rate, basically say a T-bill, a 3-month treasury bill. So we're paying the treasury bill and we're receiving a fixed amount. Okay, this would be one plain vanilla interest rate swap. Then we could have a second plain vanilla interest rate swap, and for each of these periods, again, as we go through here, in this case we would be paying LIBOR floating, or you could just denote that as L, okay? And then you could be paying a fixed amount right here. Again, this fixed amount, this fixed interest rate would be nothing but the weighted average of the expected forward rates, the interest rates in the future that we expect to happen. This would simply be an average of those LIBOR rates. And then we would be actually receiving LIBOR as it materializes. The same thing with this swap here. This is basically treasury swap, where we're receiving a fixed payment, and that payment is the average of the expected forward interest rates that we expect to see in the future. And then RF is the actual interest rate that materializes over there. So if you look at this, what happens is we're basically looking at a fixed component and then a variable that changes component. And you can look at this as, look, there's a receipt of RF here. There is a fixed cash payment received here, and we'll call that RF, and we'll call that fixed. And we're paying here a fixed based on LIBOR. Okay, and so it's this fixed difference. This difference will be fixed, the difference between these two rates. And this rate, by the way, will probably be negative because LIBOR is usually a little more than the risk-free rate, because LIBOR, recall, technically has some default risk in that it's an interest rate associated with a large financial institution, and the financial institution is subject to possible default. And then the floating or the changing rates here would be, you're getting LIBOR at each period. See right here, put a little T here, LIBOR each period as it materializes, and you're paying FT, the risk-free rate, as it materializes over time. And so really what you're looking at is, okay, this is a constant, and this is what varies. So in this situation, in this particular example, we're hoping that LIBOR, the spread between LIBOR and the risk-free rate, widens. And if it widens, this difference will increase and we'll have a positive payoff. Let's look at a specific example, and it's in your notes. So you suppose you are the chief portfolio manager of a large financial institution with several subsidiaries. Subsidiary A just entered into a $50 million notional swap with a fixed rate of 3%. The swap is receive fixed and pay 3-month LIBOR quarterly. Okay? Oh, so let's map that out before we go any further. Here's the quarters. Okay. You're getting here, you receive fixed. Okay, 3%. And according to the notes, the description here, you're paying LIBOR, 3-month LIBOR. And so we map out those. This is the cash flows. Okay, you know it's 3-month LIBOR because in the brackets here, it covers a 3-month period based on a rate that started in advance and it settles in arrears one period later. And so that is subsidiary A's swap that it entered into. Now let's continue reading the narrative here. Subsidiary B just entered into a received floating based on 3-month US T-bill rates plus 35 basis points and a pay fixed swap. Ooh, okay, so let's look at that. B. Subsidiary B. They're paying 3%. So that's the down arrow. It's the payments on the bottom. What's coming in is the risk-free rate plus 35. Risk-free rate plus 0.35, 35 basis points. Okay. And so now the question, let's read further. It says both swaps pay on a basis of 90 days, and there's 360 days in a year, pretty standard. The tenor is 1 year. You are about to enter into a meeting with the board of directors concerning the consolidated financial statements of your firm and the firm's overall interest rate exposure. So that's an important question that the board may want to know about. What type of exposure do you have? So how would you explain the impact of the two swaps on the overall firm, and how would you support your answer if questioned by the board? Well, if you look at each individual swap by themselves, you say, wow, you know, there's substantial risk here. Here are the risk in A is, look, if LIBOR goes up, then we're going to lose out on this $50 million swap that subsidiary A has walked into. And for B, if in B, if the risk-free rate falls, because that's what we're receiving up on the top part of this line, then B could be underwater. Subsidiary B swaps could be underwater. But the point is, and this is often a fallacy in finance. In finance, people often make the mistake of just looking at compartmentalizing and looking at one asset at a time and the risk associated with that one asset at a time without really considering the net or portfolio effects. And it's the net effect, which is what we're interested in, and that's what we're going to look at here, the net effect here. The net effect turns out to be basically those two combined plain vanilla interest rate swaps turn out to be a basis swap with very little risk overall. And let's map out the cash flows here. Okay, so those are the cash flows. This is the net effect on the entire firm. Okay, and what you see is a basis swap, because you're basically swapping two floating rates. Plus this little fixed 35 basis point effect here. But notice what happens is in these swaps, there's no movement in notional value. Remember, in a swap, there's no notional value swapping back and forth. It doesn't make any sense. So there's no notional value flipping around here. So that notional value is the subject of a lot of risk. It's gone. Doesn't happen in this situation. What's happening is your company has a bet on the spread between T-bill rates and LIBOR. And in this case, we're looking for the risk-free rate to go up relative to LIBOR. And then in that case, that's where the money will be made. So you can look at it from this perspective for a basis swap, but you can also think about it, people speculating using basis swaps because they think T-bill rates are going to increase relative to LIBOR. Maybe you think, well, maybe the Federal Reserve in the United States is going to start increasing short-term rates and constricting monetary policy. In Europe, may not be doing that to that extent. And so LIBOR may end up being dampened relative to the T-bill rates. But keep in mind that it's a difficult call or prediction to make because short-term rates tend to move in sync with each other. But that said, they often do, on the other hand, pull apart and move together. Okay, now let's cover a commodity swap. So instead of swapping payments based on interest rates such as LIBOR, commodity swap is based on the price of an underlying commodity. When I say price of an underlying commodity, it's the price of wheat, the price of rice. It could be oil, it could be gas, and so the prices are often a function of the units. So if it's wheat or rice, it could be bushels. If it's gas and oil, it could be gallons. Okay? So in these cases, one party agrees to pay a fixed price for the commodity over life, and the life is called the tenor of the swap, while another party agrees to pay a floating. Okay? Typically, the underlying commodity is not exchanged, only the payments are netted out. So I have an example, and the example goes like this. A commercial corn farmer may have a strong motivation to enter into a commodity swap. Corn prices gyrate up and down based on seasonal factors, weather conditions, regulatory environments, even supply and demand for ethanol, which is an additive to gasoline. Okay, with a swap, the farmer now, so that's the situation a farmer faces, but with a swap, the farmer can essentially lock in a selling price for harvested corn over the next couple of years while agreeing to pay the going price of corn over the same period. Now you say, wait a second now. This farmer is agreeing to pay the going price of corn and receive a fixed amount. Well, first you think, well, the price of corn could go up a lot. And so why would this farmer want to do this? Well, when you start looking at it from a swap perspective and looking at how it nets out, you'll see that what the farmer is doing is they're swapping a variable corn, the variation in corn prices, which means his farm is susceptible to a drop in corn prices. He's swapping that to get a fixed corn price. So he agrees to lock in the corn price now, and then watch what happens in the future. Now, it could be the corn prices drop dramatically, and the farmer is quite happy they entered into the swap. It could be that corn prices skyrocket, in which case the farmer is kind of not too happy they entered into a basis swap. But in any case, what's happened is they've locked in a price and they've gotten rid of the risk associated with farming. So, what does this look like? Well, the farmer let's just make it over 3 years here. The farmer is going to get CT, and that's the price of corn per bushel. Okay, so that's what we're looking at, the price of corn. So these are, say, the next 3 years, and whatever this price of corn is, this is what the farmer is going to get. That's the farmer all by himself without a swap. Now the farmer enters into a commodity swap, and with the commodity swap, the farmer gets a fixed price for corn. That's what the bar stands for. C bar means fixed price for corn, and pays CT, the going price of corn as time materializes. And so look what happens when you net it. The net effect is CTs cancel out, and the farmer now gets a fixed rate. And that's it. The farmer gets a fixed rate here and is basically swapped out this risky variable corn per bushel price and is getting a fixed price for corn. Okay? And so remember, you're going to need a notional value. So the notional value in this situation would be the amount of corn the farmer has planted or can plant for a given year. That said, there is one thing that needs to be considered here, and that the farmer is still at risk in that if a farmer goes into a swap with, say, a notional value of 100,000 bushels, the farmer should come through with being able to harvest 100,000 bushels. And if there's a drought, seasonal weather problems, and the farmer can't produce the 100,000 bushels, that could be additional risk that needs to be accounted for when the farmer puts on one of these commodity swaps. Okay, the third swap here is an equity swap. So here, in an equity swap, counterparties exchange payments based on a notional value. The notional value doesn't move itself. It's the rates of return on the notional value. And it's a notional value of stock, or a stock portfolio, or a stock index. And so let me just jump into an example of how mechanically this might work. Let's assume that you're a portfolio manager of a mutual fund, and your portfolio tracks the S&P 500, and you suddenly become bearish on the stock market. The fund's bylaws forbid you from short selling, and the use of options and futures. Well, we've heard this before. It's not uncommon for bylaws to prevent portfolio managers from doing certain things. But that said, the bylaws are often silent on various other types of derivative contracts, which opens the door for these type of swap transactions. Okay, so now this portfolio manager is bearish, and the portfolio manager is managing $1 million portfolio. So if the portfolio manager is bearish, they could just sell the $1 million in stocks that they own. Okay, but that would be extremely tax efficient, because you're triggering capital gains, which will be subject to taxes, and you'd have to pay the taxes now rather than later. That's what we mean by being tax inefficient. So instead of selling the $1 million portfolio, you decide to enter into a total return equity swap with a notional value of $1 million on the S&P 500. You will receive fixed payments and pay the variable side. The fixed side of the total return swap pays, say, 4% or 1% quarterly, and the variable side pays the actual total capital gains and dividends return earned on the portfolio. If the S&P yielded 7%, then your return would be you'd pay 7% and receive 1% fixed. So you'd be paying 7% and you'd be getting 1% fixed if the return on the S&P for that quarter was 7%. And so the net payment would be minus 6% here. You'd pay 6%. Now, if the S&P turned out to have a total return of minus 8%, like you anticipated, a drop, right? So total return would be minus 8% for the quarter. You would receive a net payment of 8% plus 1%. So this would be negative 8% here, right? So you're paying a negative, which is a positive, so the whole thing nets out to be a positive 9% for that equity swap. Now, that was just a quick and dirty example of an equity swap. These swaps turn out to be quite interesting in that you might ask, well, how is one priced? How is an equity swap priced? In other words, how do you determine the fixed payment? And here I just said, let's say it's 4% per year, 1% per quarter. It turns out, interestingly, that the interest rate associated with an equity swap turns out to be a risk-free rate, something like LIBOR, or close to a risk-free rate like LIBOR, the cost of funds for a dealer, which is quite interesting. And it's like, well, how can you swap a equity return for a low interest rate, close to a risk-free rate? LIBOR is close to a risk-free rate with a little premium for the fact that the financial institution that you're depositing the money in may default. So that's a bit mind-boggling. I'm not going to get into it. Just a little teaser. The textbook discusses it, and it's almost counterintuitive. But I invite you to take a look at it and see how you can reconcile that in your own mind. Obviously, since I'm not going into the details and not proving that result, I'm not going to ask you this question on a quiz or an exam to try to prove this idea that an equity return can be swapped for a really low interest rate with hardly a risk premium in there. But nevertheless, it is interesting, and I invite you sometime to look into that and try to reconcile that in your mind. Now what we want to do is let's look at credit default swaps. We'll cover it in a little bit more detail, and I'm going to cover it in a way that's really not introducing much new material at all. And I'm not going to get into actually the heavy mathematics behind pricing the credit default swap. I'm going to use timelines, and you're going to see that basically we already have much of the intuition already with an understanding of plain vanilla interest rate swaps. We just need to arrange those plain vanilla interest rate swaps in a fashion that makes sense in terms of credit default swap. So let's jump right into an example of a credit default swap, so we can get a handle on just the basics at first before we get into just a little bit of detail. The example is, suppose that a bond mutual fund owns 1,000 7% annual 4-year maturity unsecured bonds. Okay, that's a mouthful. So they own 1,000 bonds, roughly $1,000 each. Because remember, a bond is worth about $1,000 if it's trading at flat, not at par, not at premium. It has a 7% annual coupon, right? 7% annually is paid. It's a 4-year maturity. It's unsecured, meaning there's no collateral behind it. And it's of AIG, a large financial institution. The yield to maturity on the bonds is 7%, and that means that the bond market, the people in the bond market want this bond. They expect this bond, given its risk, to trade at 7% in yield and generate 7%. And the bond does actually have a coupon that generates 7%. So for sure, this is a $1,000 bond, because remember, your bond trades at par value when its yield to maturity equals its coupon. It does. The mutual fund now is subject to credit risk, and the AIG's bonds could get downgraded or they could default. Okay? AIG bond prices are already depressed, and the mutual fund does not want to take a loss in the bonds by selling them. Okay, so it has a position in these bonds. It's lost a bit of value on it. If it sells them now, they're going to take a loss and recognize a loss, and they want to avoid that. So to protect itself against further price declines, the mutual fund contacts a credit default swap dealer. The dealer offers to sell credit protection with a notional value of $1 million with a 4-year tenor, and tenor means the life of a swap, for a price or a premium Okay, and that they basically mean the same thing for a swap. The price of the premium that's paid, the insurance premium, of 175 basis points. Now, map the transaction and the parties involved. Okay, so here we got a bond fund. Here. And then we have the credit default swap dealer here. Okay, two parties involved. Hey, the bond owns a 7% coupon AIG bond, and what that means is that 7% is going into the bond fund because they own it. Okay, and so this bond fund's at risk because if this bond defaults, this arrow is going to disappear. The bond fund's not going to get that coupon, and it may not even get its principal back. And it really depends on the situation, as how much does AIG really default? That's another story. But let's say they do default and it causes losses. How does this bond fund protect itself? Well, like I said, credit default swaps is this bond fund is going to buy insurance on this credit. So the word credit means credit in these markets mean loans or could mean bonds. In this case, it's a bond. Okay? And so how it's going to work is the bond fund is going to pay, we usually label it X for a spread, and here it's 175 basis points. Okay, well 175 basis points, right? That's 1.75% basically times the $1 million notional value. 1 million times 0.0175. That translates into $17,500 insurance premium per year that the bond fund is going to pay to the credit default swap dealer. And in return, the credit default swap dealer, and the dealer probably has offloaded this, by the way, so I'm just simplifying it, that there is a counterparty here, and I'm just referring to it as a dealer at this point. You could just think of it as another financial institution on this side. But on this side, there's going to be, this money is contingent. This arrow is contingent on a credit event. And a credit event would be, for example, the bond being the bond defaulting, the company going bankrupt, or even to a lesser extent, a downgrade by one of the major credit rating agencies. So remember, credit rating agency? Yeah, so it has to do with bonds and loans being evaluated. So this arrow here is contingent, and this arrow is $1 million, okay, if credit event happens. And you could be sure that in these contracts, the definition of a credit event is spelled out very, very carefully to make sure that if there is such an event, that it's clear as to when these payments actually get made. Okay? So once this payment gets made here, the insurance premiums stop in a sense because the credit default swap dries up, disappears, or dies once the event happens and there's payment. Okay? Kind of like your insurance contract. Your house burns down, you get a payment from your insurance company, you're not going to pay premiums because you're not insuring something anymore. So the premiums will go away after that. Okay? Very simplified example here. So that is the basic outline. And so what we want to do is let's look at where the heck does this 175 basis points come from? That's what we want to do next. Let's explore that, and we're going to explore it through a process called replication and arbitrage, something we've been doing all semester. So let me show you how to do this. Okay, to show how replication and arbitrage can be used to price credit default swaps, I have a series of timelines here. The first timeline represents a bond that we're going to buy. We're going to buy a bond, and that's why at time 0 there's a down arrow for the par. We're paying par value for this bond. Keep it simple. Par value. There's no premium, no discount. It's $1,000. The bond's going to pay off LIBOR, which is a floating rate, plus a fixed rate X. It's going to pay it off each period, 1, 2, 3, and 4. And then on the fourth payment, we get our par value back when the bond matures. Now, let's assume that we can finance this bond. And we're going to finance the bond. That means we're going to borrow money. So we're going to, at time 0, collect to get proceeds of par. And you can see that it's a financing because the money we're getting for the financing is paying that par value just above for the bond. But now, let's say we have a better credit rating than the bond that we're buying. So maybe we're buying a junk bond and we're near investment grade bond or a dealer that has a cost of money that's LIBOR. And so the financing costs LIBOR each period. And so 1, 2, 3, 4 periods, you pay LIBOR, the floating rate, and then you pay back the par value on the financing when the bond matures. So the par is net out in the bond and the financing. Okay, so let's look to see what that package generates. And I mean package, I mean we bought the bond, the floater bond, and we financed it with a floating loan. So if there's no default, notice what happens. You know, all the pars cancel, and the LIBORs cancel too. And what we end up getting is X across each of the time periods. And if you look at that closely, what that represents is, look, that could represent a credit default spread. You know, because if you have a credit default swap and there's no default, you're going to collect X each and every period, a fixed amount. Okay? Now, if there is a default, let's assume the default happens immediately after time 0. And if that happens, the bond, the top line, timeline disappears. That investment we have disappears. And what's going to happen is if that investment disappears, then there's no reason for the financing. So we're going to unwind the financing. And so that means paying back par value just about at time 0. We pay back par value. And look what happens. We get no cash flow because we don't have any financing and there's nothing to finance because the bond disappeared. It defaulted completely. So from this scenario, from what we have here, can we figure out the price of a credit default swap? In other words, the credit default swaps spread. Let's continue here. Now, how do we know that we can do this? Well, think of replication and arbitrage. We just showed that the package above, the floating rate bond plus the financing generates the same cash flow as a credit default swap, or at least an X amount, right? Now the question is, does that X equal the spread? And let's check. So we'll run a couple of scenarios. So now the first scenario, and this is reminiscent of the bond stories that we had, or the option stories that we had a long time ago. So here's the scenarios. If X, that fixed amount that was on LIBOR, if that's greater than the spread on a credit default swap, right? If that's the case, why don't we buy the floating rate bond, receive LIBOR plus X, finance it by paying LIBOR, like we just said, buy the credit default swap, right, and pay S. When you net that together, it comes out to be greater than 0. Okay, so what we just did was we managed to put together a package of a bond and a financing and showed that, you know, it kind of looks like a credit default swap. And we compared it to a credit default swap. And if the payment's X is greater than S, then we should buy the credit default swap, pay that little amount X and get X. Now, if S, the spread on the credit default swap, if that's greater than X from that LIBOR amount, short the floating rate bond above, and when doing that, you're going to pay LIBOR plus X, invest the proceeds at LIBOR, sell the credit default swap, and receive the fixed payments of S. If that is the case, then you'll end up with an amount greater than 0 because the spread is greater than X. Therefore, if you reason it out, if there's no arbitrage available, X will equal S. And what that implies is something pretty interesting. It means that that extra X that we had on the bond above represents extra premium on the bond relating to a credit event or credit default, which is really interesting. That's what it boils down to, according to our analysis right here. It's a very simple analysis with caveats. Okay, obviously the credit reference for a credit default swap. So a credit default swap needs to be tied to a particular bond or credit loan. And in this case, we have to make sure for sure that that credit default swap's reference is the bond that we're looking at. We just assume that. We need to make sure the credit default swap and the bond have the same maturity. And as an aside, if you look carefully at the way credit default swaps work, is that when there's a credit event, rarely do you lose 100% of the credit value. In other words, bondholders or people who buy loans don't lose 100% of their investment if there's a credit event. They often lose ballpark 60%. So the rule of thumb over a long period of time has been that payoff to a credit default swap will be face value, which is par, which is why I talked about par being the price of the bond, minus 40%. So really it pays off 60% of the face value of the bond. We've ignored that issue, but these are some of the issues that you need to take into consideration in the real world.